After this last video, a lot of you still had some outstanding questions about overseas pensions, private pensions, pension planning, lots and lots of pensions questions. So to help me answer those questions, I invited Amanda Johnson, International Financial Advisor. And we also invited Micala Wilkins to represent the voice of small businesses in France. We digress, we overspilled. I've had to perform some fairly brutal cuts on this, but hopefully you will find it interesting and informative. Ladies, pension planning really, I think, is the key thing, isn't it? Because this is not something we can improvise at the age of 60.
Yeah, I think it's something that many people don't want to because they either are scared or they just quite like being an ostrich. So if you know about what you've got, then you've got to do something about it, haven't you?
And I think, Amanda, you're the expert in discovering exactly what we may have tucked away.
Yeah, so what's a really good thing to do is to look at what you're going to get from where. But the most important thing is to find out, where did you get, what have you got previously? So if you worked in another country, so many people will be listening, maybe from the UK, or they might be from the US, or they might be from other places in Europe. So if you're in Europe or the UK, then there will be a state pension somewhere. So you can get in contact, very easy to find if you go onto the website for that particular government, and then you type in pension forecast, you will be able to, everybody's, in France we have a social security number, in the UK you have a national insurance number, and that's just for you. So you can pop that in. You usually have to set up an online account, but then you can find out how many years you are going to get and what that is in monetary, okay? And then if you've I've worked for many financial institutions in the UK, so I've got some different types of pensions. You need to make sure that those companies know where you live. That would be nice. Then they can tell you. If you're not quite sure and you think, oh, well, I think I work for that company and I don't know whether they had a pension scheme or not, you can write to, in the UK, the Department of Work and Pensions, and they do a pension tracing system. So you give them you just write them a letter, national insurance number, the addresses where you were living, and roughly the times and who you're working for, and they will do the magic. We did this and we found that my husband had a pension pot that's worth about £100,000. So he didn't even know anything about that. So, you know, it's like looking at the back of the sofa for a coin. You never know what's going to be there. So have you got any personal pensions? Have you any existing work pensions? And then finally, what are you getting from companies and countries that you lived in before?
If we address maybe the amalgamating pensions, because we had a discussion about this as well yesterday, didn't we, Amanda?
We did.
Generally speaking, if you've worked in several different countries, then what you would do is approach the pension service from each of those different countries. So each of those pensions will be paid to you individually and independently. If the question is, can there be one amalgamated payment where all of these countries will kind of concert and collaborate and make you one nice monthly deposit in your bank account, then no, it's not going to happen. A lot of people, Amanda, we were discussing this yesterday, are asking, can their overseas work contribute towards a pension that you may get in France?
It's a tricky one because there is a website that we were chatting about that people can log where they've been in other countries. So for example, if they've done 20 other years in Germany, they can log that on and might enhance things slightly. The website that we spoke about, which is going to be in the link, and I think people need to do their own research on that.
You imagine the time and energy that would be involved in jumping through all of these administrative hoops, trying to get your French pension service to recognize time worked elsewhere. Honestly, my feeling is that if you're prepared to put that much time and energy into something, you may as well put it into earning more money here. That's going to give you a better pension for sure than tinkering with these details that may or may not have any kind of advantageous effect.
I 100% agree with you on that.
Yeah. I've got a question. My husband and I are both working in France with CDIs. although it's my intention to set up a micro consulting business next. It's my understanding that for US citizens, due to the bilateral tax treaty, qualifying for our French pension will be based on our year's work in the US, though not the amount we earned there, plus our years of work in France, and that the amount of the French pension will be based only on our French salaries minus the amount we will get from our US Social Security. Does that sound correct to you? What sort of professional would we need to talk to for help with planning for our retirement here?
Well, I'll take the first bit. I think I would just say that anybody who has a CDI is getting more generous pension contributions than you would as a micro, unless you're a very high earning micro, in which case you may want to be looking at moving out of the micro. But as a self-employed person, your pension contributions are never going to be as high as if you are somebody else's employee. So I'm not encouraging you to stay in a job that you hate, but just bear that in mind before you leave your job, that will affect your pension entitlement at the end of it. Amanda, I think the next bit was for you.
I would suggest that the person uses the website that we're going to put a link to check about their US years of work, and then they, to see how that marries up, like we were saying earlier. And I think that will give them the answer. I deal with portfolio managers that can manage Americans and US portfolios. So I can do that, that is fine. But for the pension side, you need to check out that website, because I haven't had enough experience of that. So I'd rather say hashtag I don't know rather than sort of waffle on.
And if I can just sign that question off, just with regards to people who are of non-EU nationality, because I know there were quite a few of them, and there was a question about entitlement to pension or the right to claim a pension, like is it any different in France if you're from outside the EU? And the answer is no. If you've worked in France and you've contributed to the pension system in France, your entitlement is exactly the same as anybody else's, whether you're from Germany or Jamaica. Like, really, it makes no difference.
The thing I would say is I know that with my pension forecast here in France, I've been quoted 3 amounts. One if I take it closer to 64, one if I leave it till I'm 65, and then one if I leave it till 67. And it's not like we're a physical job like Micala's husband. So, sitting on my backside all day, I could probably keep on doing a little bit of that if I wanted to. So for me, I think it's really important that when you obtain your forecast, that you actually have a little look and, is it worth you waiting until you're 65 or 67 to get a slightly bigger pension?
Yeah, because if you go to 67, this is something I didn't go into a lot of detail about in the last video, but if you look at the simulation that I did in the last video, and even if you do your own simulation, you'll see a big jump at 67. And so that's because even if you have a very small pension entitlement before 67, at 67 it will go up, but that is reliant on you working until 67, as Amanda just said.
Which leads on to a question, being married to a tradesman who, and many others in France, the thought of working to 67 may be impossible for some trades. So will there be alternatives that a 62-year-old can think about? For instance, my husband might want to consider at 62 downsizing the business. Does the pension pot stop at 62, or is it still kind of accumulating in order to get your full pension at 67?
No, if you're still working and you're still contributing, then that time is still counted until you're 67. Right. Your revenue is going to take a dip because you have less professional activity. And so those years may not be the best years of your career. And bear in mind that your pension is calculated over your 25 best years. So they won't be his best years, but they are still counted in his years of activity. Unless he's got 25 other best years in France, but that means that you need to have worked for a long time in France, right, to qualify for that. So it's going to lower the average somewhat, but he is still contributing. Obviously, then if you also have private pensions that you can break open a bit earlier, then that's going to help, isn't it, Amanda?
To work with, maybe if you've got some other provision, that can then give you a bit more choice, because at the end of the day, that's what money does. Money gives you more choices. And I think at the end of the day, that's what That's what we want. We want to be in control and choose what our retirement looks like and when it happens.
There was another question, buying trimesters to cover the gaps.
Okay, there is an opportunity to buy trimesters, but to buy trimesters, it's quite complex, but I'll break it down. Effectively, you would have to contribute all of the money that you would have contributed if you were working during that time. So it's based on the average salary that you have so far. So for everybody, it's different. There isn't a price of like 10,000 euros per trimester or whatever. It's really dependent on what your average earnings are, and whatever you would have contributed during that period, that's how much it's going to cost you to buy back those trimesters. So it can work out expensive. You do have to dig into a bank account. You have to find some money to be able to pay for that. And if you have that money to be able to pay for it, well, you can probably put it to better use. You could probably invest it, couldn't you, Amanda?
If I can add to that, if somebody's looking at buying back, in particular the UK, then yes, you can. And if you were working in the UK before you left and you're working in France, then you can elect to pay a different class of national insurance contributions, which, for example, for myself, rather than pay, I think it was £851 for each year I was missing, it was 151. But obviously with that comes, it does come with some extra things. So for example, it's assuming that you're going to take your French pension, you're going to be entitled to a French pension. And then when you start taking your French pension, it releases the UK of providing you with an S1, which then means if you were here before the withdrawal agreement, when you get to age 67 and you are claiming your UK state pension, you can apply for an S1, which means that you will not pay any social charges on any of your pensionable income, whether it's state pension, personal pension, or company pensions. Okay, so I think people need to be mindful that when you pay reduced contributions, it's assuming that you're going to take your French pension, which will absolve the UK from providing your healthcare costs. So I think that's something that people need to be aware of.
How does the S1 fit in for certain people then? Because since arriving here, we contribute to the French system. So
absolutely. So the reason that the S1 would kick in would be if somebody, let's say that they look and they've I don't know, they've had a very small sort of hobby business, and they're going to get paid, I don't know, €50 a month from their French pension. Well, if their full UK state pension's about €12,000 a year, if they take that €50 a month, then that means that they're going to have to pay social charges on the full 12,000. Yeah. And you can say, I do not want my French pension. Thank you very much.
So what you're saying is that for those businesses that have deliberately stayed small, not only have they deprived themselves of the income during their working life, but they're also depriving themselves of a reasonable pension at the end of their working life and potentially impacting negatively the rest of their pension.
Yeah, absolutely. Yeah. Because, you know, we do look at it and people say, oh, well, maybe, you know, I'll receive an inheritance. Well, we don't know about that. We don't know what, there are inheritance tax rates that are ever changing. So what you might have thought you're going to receive, you might find that more taxes are due over in the UK, or if you're inheriting here, you know, I just don't think you should rely on that, because that's assuming that, you know, the person you're inheriting from is in good health. You know, it might be that they need to use that money to pay for their health, in which case there's less available to leave as a legacy. And then you could say, well, I'll downsize. Well, that's fine if you've got a property that you can downsize from. You know, I think the thing that I would like to say is that in particular, if you've left, many of us, if you've come from the UK, for example, our properties in the UK were worth an awful lot more per square metre than they are in France. And so we have had the ability of paying less rates, or if you're my age, poll tax or what's called them. We haven't had to pay thousands of pounds a year in that. We haven't had to pay for the cost of living on the outskirts of London or wherever that might have been. So we have benefited the last 10, 15, 20 years of a cheaper way of living. And really, if we want to downsize, what can we downsize to?
I think you're definitely right that moving over here at an average of 40 years old with your house already fully paid off is a huge advantage. Of course it is, but it's only going to remain an advantage if we can keep on earning money, right? Otherwise, all you're doing is you're just depleting your capital, and you're getting poorer and poorer all the time. Because your house isn't going to appreciate all that much.
Absolutely. And we don't have the schemes here that I know in the UK, when you're over the age of 55, you can apply for I think it's called an equity release, where you can release, some amount of money. So you've paid the mortgage off and you might get a third of what your property's worth. And then you don't pay any of that money back until you die, and it dies with you. Hence the reason there might not be as much inheritance coming your way. But there isn't that here. There isn't that system. So the only way to get your money out of your property is to sell it. So if we start looking at all of those things, if we're catching somebody early and they're just moving to France and they've bought a property and they've paid for it in cash, can you start putting the money that you would have paid for a mortgage away on a monthly basis to save that? Because you won't do it, and then you've had 20 years of not having to pay for a mortgage, but you haven't done it,
exactly. You haven't made the most of that advantage, and then the advantage is gone and it's too late. So then start working seriously as soon as possible. And I know most people, when they move over here, they think they're leaving, we mentioned this, but they think they're leaving that hamster wheel. And it's not true. There is no easy get out at 40 years old. You're just swapping one hamster wheel for
another. When we moved over here in 2012, we had 3 months savings and we rented for 3 years, which was the impetus. When we applied for a mortgage in 2013, the bank laughed at us and said, you're wasting our time. Just go away and work. And we just thought, right, okay, and that's what we did. It was the impetus to work like mad to get some money together so that we could be taken seriously, by which point we had proven ourselves to be a decent risk for the bank to give us some money.
So it's adopting this mindset. It's very easy to say it's too hard to do here, and there are lots of people who will say that, and I think if you hang around with people who say that, then you'll end up believing that. And if you hang around with people who say we can do it and we're going to do it, then that's what you're going to end up doing. Like, look at you, Micala, you have Paul has a small business and it's done very well. And the only difference is that you didn't feel victimized by the system. You just said, we can do this, and and you've been and done it. That's it.
Which leads to another question. Some of us have arrived having experience of being business owners in the UK or from wherever around the world. But there are many that have come over, especially, I suppose, with post-Brexit, the requirement to have business plans. But even before the withdrawal agreement, many would have come over who were quite new and novice to running a business. And I would imagine it's been a huge shock and a learning curve. What advice would you have given to somebody that had arrived here 5 years ago to progress to a new level?
Yeah, I think the first thing is just accepting the responsibility, Micala. And funnily enough, I had a client exactly like that yesterday, exactly like that. And doing well, but not getting much further and not understanding why. And this person just had not come to grips with how their business works. And it's the ABC. It totally, you need to do that. And after that, the rest of it is just common sense. It's just behavior, Micala. You know, like it's 80% of wealth building happens here. And it's not because it's France that it's any different. It would be the same in the UK or the US or anywhere else. It's here. And once you understand that it's you who's responsible, and that you need to know when you want to move your business on, and not wait for somebody else to tell you when to move your business on. It's not because you've reached X amount of thousands a year. It's because you have a project now and you want to take it somewhere. Well, then you will start to see some progress. And also, it's really important to stay with positive people as well. There are too many negative people, and negativity, I always think, is contagious. So.
Yes, totally agree.
Yeah. And the other thing I would say is, if you look at an aeroplane, okay, how does an aeroplane, it has all its effort and all the thrust, is it thrust? And they just go for it. And it's how much energy to get it off the ground, and then it's just off the ground, and then it's on its way, and it takes, you know, it takes a while, and then it's up in the air, and then you can just.
There was a lady who was asking about British private pensions, and should she bring it all over in one lump sum and pay all of the tax, or, I mean, or take it, you know, at the time.
Okay, so there's a really long answer, and I'm going to try and make it really, really short. If you took all the pension all in one go, then the UK will tax it as earned income. So let's say your pot's worth 100,000. The first 25% will be tax-free. The remaining will be taxed as earned income. And if you don't earn any money in the UK, they're likely to do you an emergency tax code. So that's about 40%. And then you've got to claim that money back from HMRC. And that can take a good 3 to 6 months. But a lot of, you know, there's some forms you have to fill in. You've got to get it stamped and signed off by the French fisc. Then you've got to send it to HMRC, and then you've got to phone them on a regular basis to say, can I have my money? 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 And all of that energy you could be putting into your own business, really. And then you've got this lump sum. What are you going to do with that? And then it's going to be taxed here. Okay, so if you take in your full pension of 100,000, you've now got all your tax back from the UK. You've then got to pay your taxes here, so there'll be tax to pay here, and there'll be social charges. So sometimes you might be better off to say, okay, well, I'm going to have it on what we call like a flexible drawdown, and just draw down what I want, what I need every year based on, you know, what my business is doing, how much tax I want to pay, and then just do it, take the bits as and when you want.
That Amanda answers a question that somebody had here. Am I correct in thinking that if I claim both my UK and French pension, I would have to pay 40% tax on bringing the UK one into France? So
no, there's no if she's taking her UK state pension, okay, all that's happened is going to be paying you every month. You're not going to be paying 40% tax, unless you're adding this to your other income, and then that puts you in the bracket. But believe you me, in France, pay 40% tax, you've got to have a lot of extra income coming in.
Right. So Amanda, for people like Paul and myself arriving here in 2012, likely to have an average of a 20-year work career here in France. So when we claim our French pension and then our UK, we'll still have a tax liability to put on our tax return for incomes derived outside of France.
Absolutely, yes. So all you'll do is I mean, you know, most people get their UK state pension, they get that paid in France, in euros, in your French bank account. And all you have to do is just write down the amounts that you get paid every month and put them on your... So the UK government will pay it all to you without deducting any tax, okay? There's a few bits and bobs you need to do along the way. You need to write to them, let them know that you're here and this is where you pay your taxes, so that they won't deduct it. But there's certain circumstances where the UK government will tax you, and that's on very specific pensions. But for your UK state pension, no, they won't take any tax and it will be taxable here.
And a question for you then. Let's say, for instance, you had somebody that's been over here 5 years. If they had a spare €50 a month, where best would they be doing with that?
Okay, so you start up with 50, you've got nothing else. Then number one thing is to use something that's tax efficient. So something that any interest you're going to get paid, even if it's teeny, weeny, the taxman isn't having a bit of it. Okay, so to start off with, I always say, look at your Livre A accounts. Okay, so you can save up to 22,950. So get going on that. You also have other regular savings account, which is there's one that I think is really good, which is the PEL. Okay, and that one you generally have to open it with a set amount. So it's usually around about €250, sorry. And that one you have to pay a certain amount every month without fail. It's a little bit like the old-fashioned save as you earn. So you set up a pre-level one, and it might be for €45 a month. In it goes. If you draw that money out in the first 2 years, you don't earn any interest. But if you keep it there for the 4 years, you get extra interest. And the rate on that is better than the Livre A. And that will also help you if you wanted to maybe get a car loan at a later date, or you wanted to look at borrowing some money because the bank can see that you're regularly saving some money. Okay. Once you've built up like an emergency fund, then you can start looking at things where the money's invested. Now, obviously, I can't talk too much about that because I'd need to know a bit more information, or quite a lot more information. But there are things then that you can invest for long term, and again, that will depend on how long you want to invest it for. What your appetite to risk is and volatility and so forth. But number one stops are Livre A, and then look at something like a PEL. You don't have to put the full 22,950 in the Livre A, but once you've got yourself a nice little amount then, and you've got used to regularly saving, then have a look at the PEL. But one thing I would say is please, still do the things that give you joy, and meeting with people that may be business people that can help you feel energized about your business. That's always worth an investment.
Do you have any final words that you would like to?
I love a final word. So
have a final word, Amanda.
My final bit of advice is it's not too late, and all you have to do is to start. Okay, just start. It can be a tiny amount, but you're doing it. Just as Nike says, just do it.
And no, it's not too late. Remember that Colonel Sanders opened his first KFC when he was 67 years old. We had a lot of fun doing this, so if you would like us to do it again on any other subjects, then please do let me know. If you found this helpful, I'd really love it if you subscribed, and I'll see you again soon.